Good morning, everyone. This is Joe. I'm long gold now.
Our morning on Squawk on the Street. Fast Money begins right now.
I'm Melissa Lee, and this is Fast Money. Tonight's trader lineup: Guy Dami, Tim Seymour, Dan Nathan, and Jeff Mills. Tonight on Fast, a second half surge. Fast Money friend Tom Lee is here with his outlook for 2022. Why he thinks the biggest gains may not come until Q3 of next year. Plus, Jack Dorsey takes on Web3, what the Block CEO had to say about the next generation of networking and what it means for the stocks involved. And a big bounce for China Tech. K-Web approaching a key level, according to one of our traders. But is it time to jump in, or should you continue to tread lightly? We start off tonight with a big bounce for stocks. The major indices clawing back their losses from yesterday. The S&P 500 up nearly 2%. The Nasdaq almost 2.5%. Energy, technology, consumer stocks leading the gains today. Check out some of the moves in the reopening stocks. Those are strong. Expedia, Norwegian, Live Nation, and others all seeing outsized gains. So do these big moves suggest the worst is behind us? Guy, how do you digest this all?
Well, if you watched Fast Money last night, Mel, which I know you did because you hosted it, we actually alluded to this. And listen, as you know, I'm wrong constantly, but we got this one right last night collectively. And we said a number of things. We said, look, on the positive front, the IWM protected critical support, as did the XRT, as did the S&P 500. We actually talked about that prior all-time high of 45.30. We traded down, we bounced. We said the VIX sold off late. All things pointed to a rebound. Now, I will tell you, I didn't think we'd have the rebound we had today, but here we are. And I think it's going to continue to grind higher into the new year. Not because I'm crazy bullish, because I've seen this movie before and I see what happens this time of year. And I thought what was interesting last night, Jeff Mills talked about it, the fact that the airlines had a big day, names like Expedia had a decent day, and they built on it again. I'll say this and then I'll stop talking. The airlines all topped out in April, long before anybody heard of a variant. Now they're starting to turn now. Makes you wonder what they knew then and what they know now.
Oh, interesting. We were commenting yesterday that the message of the market wasn't a clear one in terms of virus on, virus off. However you want to put it, we did have Carnival, for instance, Lyft, American Airlines. We had those go higher. We had the staples go higher. It's almost the same thing today, Dan. I mean, we had technology, we had energy, we had industrials, we had financials. I mean, so many things are up that don't necessarily mean risk on, risk off, or value versus growth.
Yeah, Guy is right. I think that a few of them, I was not in that camp, were saying that it is on. And we were talking about Tom Lee. I know Tom's going to come on in a second, but he was talking about pinpointing today is the day when it starts, the Santa Claus rally. A little too granular for me and what I can do in the markets, but he nailed it. I'll just say this. This morning, what I was looking at very closely were those mega cap names, and they were underperforming. So I was thinking, okay, maybe we start to see a little bit more bifurcation. We'll see money move back into those sort of reflation or those reopening trades, but then it just became a full-on, just panic buy here in the close on the very highs. And so if we were open a couple more hours, we might have been up another 2%. To these guys' points, it's really hard to fade this in what might be a sort of low volume period over the next week. And just let's remember, the S&P 500 was still up 20% on the opening today before we got that big surge. So, listen, I don't buy moves like this because to me, I think the higher we go into year end is the harder we fall in January. And I think that's the best setup for equities as we head into next year.
We had some really interesting and really strong moves in a diverse set of sectors. And Tim, I'm curious what you think could be head fake rallies versus real ones into 2022.
Well, I think the move in the financials, so over 2% on the XLF. Yesterday you had the trade, actually intraday today, you had the trade below the 200-day, and I talk about this a lot when they trade through to the downside. When was the last time you did that? And that was back in November of last year. So in other words, financials, even for the struggles with the yield curve, had really held above these levels, although had weakening trend lines. And so, when you see back to where financials went in November after they traded below there and they consolidated, and again, we had a bit of a growth scare back then, they traded up 50% in the next 6 months. I don't think financials have that in them, but we've also talked how financials seem to bridge the gap between people that are concerned about high multiples, and I think stocks that have very solid fundamentals and could be positioned for a slower growth environment. When you look at, we're going to spend a lot of time with semiconductors. I'll just talk about the high multiple stocks of which semis fit in that space. The intraday low to the close today, that was a 5% move. Again, in less than, I think 9 hours or just under 10 trading hours. So the moves for a lot of folks who woke up yesterday morning, saw futures down significantly, and said this might be that moment. Back to Santa Claus. Like I think the Santa Claus rally was the low from October 4th through December, early December, when we went 11.5% up on the S&P. That was the move. It isn't to say, Guy talks about the last week of the year, a lot of funky stuff goes on, often good, but I think you have to be careful. Again, today is about, to me, putting the Fed at least on the sidelines for now, because I don't think the market is concerned about opening or closing. I think these reopening trades are ones that you continue to follow.
In what category, Jeff, would you put this steepening of the yield curve that we've seen over the past 24 hours? Is that for real? Does it stick, or is that a head fake?
I think it's so hard to pull narratives out of what's going on in the market right now. I think it was hard to pull a narrative out of yesterday, just given the leadership. I think it was hard to pull one out of today. I think it was hard to decipher the message between yesterday and today. So it's difficult. There's no doubt about it. And, I'm sort of in the camp where I don't think we can guarantee that the worst is over here. I do think headlines are going to get worse relative to case counts. I said it yesterday. I don't know that that's necessarily the best measure in terms of where we are with the pandemic. That's why I mentioned 4,300 as support. I don't know if we get there, but I certainly think it's possible. But the real message is, soon enough, markets aren't going to care. We're going to get desensitized to those headlines once again. So you should be buying the dip. And to go back to what Tim was talking about in terms of financials, where might the opportunities be, really over the next quarter, let's say, I do think that it's cyclicals. I still prefer that growth, that profitable growth trade for the entirety of 2022. But look at financials, look at energy. Financials, just as an example, less than 20% of financials above their 50-day moving average. That's oversold. So I think as the cloud of Omicron lifts, I think we can get another run in those types of companies. We had Nike earnings yesterday, so demand is still strong. So I'm focusing on things like that, at least for the time being.
What was that stat, Jeff? 50% are below their what?
Less than 20% of financials are above their 50-day moving average. So you have a lot of weakness there, to the point where that sector would be considered oversold by a pretty reasonable degree, statistically significant at this point.
Okay, or maybe they're at those levels for a reason, Guy. What do you think?
Well, that's like an SAT question that I used to look at and then skip because I had no idea what people were talking about. I'll say this, Jeff brings up a great point. There's certain banks that just stick out like a sore thumb, and I understand what's been going on with Citi. Obviously, some exposure to Europe has been a concern, but when Citi trades down to, close to 70% of tangible book value, there's something going on, and I think that what's going on historically has been a huge buying opportunity for a trade. So I think Jeff is right to point it out. I think it's also right to point out names that have just languished and have a chance for a bounce early in the next year.
Dan?
Yeah, well, I'll just say this. I mean, like, here, look at your XRT. Guy had been mentioning it last night, the retailers, and look at the sell-off that they had. And when you look at banks, maybe they are signaling something. I'll just say this on a personal note. I just tested positive for this Omicron. I was meant to go on a plane tomorrow. I was meant to take a lot of lifts. I was meant to go out to a bunch of restaurants. I was meant to do a whole host of things over the next 10 days. I'm not doing that. I saw a headline this morning that Q4 growth is going to be half. We already had that happen in Q3. So I guess the question is, maybe some of these stocks and maybe some of the weakness are reflecting the fact that there's going to be a whole heck of a lot of weakness 2 quarters in a row, well below where they were expected to be. And maybe it just doesn't come back in Q1 the way people expect it to. And I go back to what Fed Chair Powell did last week. He lowered growth expectations for next year, and he raised inflation expectations. So the longer we have this uncertainty, that little scenario of stagflation is going to be a problem for the stock market, and I think the fits and starts with consumers and some of these reopening trades is going to remain.
This is the first that I'm hearing of Dan's positive test, so we hope you look good.
Fine.
You sound good. You sound just as salty as ever. Good. So I don't think that you have many symptoms yet. But Dan brings up a good point in terms of, it's not necessarily the lockdown measures that ultimately get put in place, if any. It's the behavioral changes that may be because of a positive test, or maybe just because of concern about a potential positive test, Tim. And we're coming up against a year where things are strong on the consumer front. People are spending money, and I'm just wondering if that's a worry, that the comparisons just won't stack up because of this unexpected pullback in behavior.
Well, look, concern for Dan, concern for everyone that's testing positive, and it's a time of caution. It's not a time of retreat, and I just think that we have a case here where we've been here, we've done that, and the biggest concerns are the Fed. I'll say it one more time. More Fed equals more volatility. That's what I'm concerned about. I think the consumer spending patterns and the pent-up demand going into this holiday season, the holiday season numbers are going to be extraordinary. How much is priced in? Look at the retailer. Some of those retailers now have taken some hits where you've actually looked past that. I mean, look at a Best Buy. I think the setup there is very interesting after we got some numbers that knocked the stock down almost 30% over the course of a month. And yet I think they have sustainable trends, especially across even some of their repeatable business, their total tech trade, but margins that are moving higher. I don't think the consumer changes overnight. I think the market is what we are concerned about. We are concerned about liquidity, but we are concerned about the Fed forces. Markets don't behave well when there's a tightening process. I think that gets us into next year, where I think there's still a lot of uncertainty, but it's not going to happen overnight.
All right. Well, as stocks catch a break, Fundstrat is out with its 2022 market outlook. The forecast calls for new highs, but it may not be smooth sailing, and they may not come right away. Let's bring in Fast Money friend Tom Lee. Tom's a managing partner of Fundstrat and a CNBC contributor. Tom, always good to see you. Ultimately, you're calling for a pretty good year next year, 11% or so, but all the gains are going to be in the back half. What happens in the first half?
I think the market's going to struggle with a lot of things you guys just talked about in the first half. It's the supply chain glitches and the way it affects both GDP growth and perceptions of inflation. And we've got the midterm elections that really won't have any visibility until the second half. We've got the Fed tightening, and that liftoff might occur at the end of the first half. But in front of that, markets are going to be nervous. And we, of course, have COVID and the various variants and mutations kind of rolling through both the U.S. and the rest of the world. So I think in the first half, it would make sense for markets to be flat or down. But the second half, I think we end up having pretty much a traditional bull market rally.
Hey, Tom, it's Tim. How about the stocks? And we've talked about this on the show where we've made mention of below the surface. There's a lot of stocks that have been in heavy bear markets, so beyond correction. Are these stocks that can recover faster in that choppy first half you're talking about? So some of the high multiple tech names, but not necessarily even that, even some of the industrial names. Again, parts of the market that are down 20, 30, 45% off of 52-week highs.
Yeah, Tim, I think there's going to be some relief in January because, Omicron came in and, in just a matter of 2 weeks went from essentially 0% of cases to 73%. And as you know, in South Africa, it burned out after 25 days. So I think we're going to be sort of relieved when that happens, and it should help a lot of stocks that got annihilated over the past couple of weeks on the heels of that. But will those names bounce and hold their gains through the end of 2022? I don't know. My guess would be first half of 2022 will be very defensive, large cap and defensive.
Hey, Tom, it's Jeff Mills. I had a quick question. I think your view is that inflation trends a little bit lower next year. I was just wondering what you thought about the impact on commodity prices and then ultimately what that means for the energy sector. I know that you're pretty positive on energy going into next year.
Yeah, energy is one of our top three groups. That's because there's a structural shortage of oil production versus demand. But I think a lot of the inflation we're seeing in 2021 is goods related. Five of the six categories contributing to inflation growth are things like used cars, autos, apparel, home furnishing. Just those five are 2 percentage points of inflation this year. So I think that's what sort of weakens. It's not necessarily commodity prices because commodities end up being inputs onto that. But, I think oil prices actually are going to distinguish themselves and probably rise, actually.
Tom, amazing work as always. So a couple of these resource names are getting off the mat at a very interesting time in terms of everything we've just talked about. What does that tell you? I'm not looking to play stock market here, but the resource trades to me significant. Talk about this global growth dynamic. Does that make sense? Are these stocks telling us something?
Basic material stocks only can rise when they sort of sniff better growth. I do think it's encouraging. I would say one of the surprises in the last couple of days has been the rally in things that are heavily impacted by both economic sensitivity and by COVID. And, maybe the market is already starting to bottom and discounting the fact that Omicron's going to peak soon. But if it is, there'll be a lot of relief because, if you don't have a big rise in mortality, COVID is becoming less dangerous. I mean, I think that could be one of the positives that emerge from this.
We know you like energy, as you mentioned, for next year, Tom. You also you liked it last year, and that was an epic call. Energy is the top performing sector year to date. And so you're saying in this new note that healthcare is positioned the same way energy is, which would imply a huge rally in next year. What sets up for that?
We were looking at relative performance, and energy's.
All right, guys. We close the couple trade with over $1,000. We close first trade was 432 and the second one for 651. Now we almost about 12,000 this month. We almost neared 15,000, like as usually our target 15,000 every month. And the total profit this year, it's about 161,000. Last 3 months we did about 46,000. So we average about 15,000 every month. That's it for today. I hope you have a good day and I will talk to you tomorrow. Take care, guys.